Everyone, hope everything is going well. All right, so I was looking at commercial real estate. This is an article from Zero Hedge, and also I've pulled some other article as well on MSN.com, but that's from the Wall Street Journal. And let's take a look at this. Office buildings are emptying in major U.S. cities like Houston, Dallas, New York, and San Francisco. And just to provide context before I get in, because people can work from home, a lot of people, what they're doing right now is a hybrid situation, go into the office 3 days and work from home 2 days post-pandemic. And even the millennials want to do that. Same with Zoomers. It may be the older generation that may want to come into the office more, but it is what it is. And the younger folks don't want to come in every day. I don't want to come in every day. That's just tiring to do that, especially when you could be as productive at home. Okay. Now, it's looking into major cities like Houston, Dallas, New York, and San Francisco. And there were four cities mentioned in a new Yahoo Finance report detailing how landlords are having a tougher time filling their empty spaces or empty office buildings with new tenants. The glut is a result of overbuilding while interest rates were lower. The report says, noting that Houston, Dallas put up new office space between 2010 and 2021 than all other regions except New York. Even more alarming is the fact that they have millions more square feet under construction. And despite discounting, vacancies are now highest in those two cities compared to any other metro area. Yeah, that's right. And a few other stats right now. Houston and Dallas had 18.8% and 17.2% of office space vacant at the end of last year, respectively. The national average is 12.5, with New York, San Jose, San Francisco, and Chicago posting vacancies of 12.3%, 12%, 16.4%, and 15.1%. It's pretty high. Data from downtown shows that cell phone activity in San Francisco is at 31% of pre-pandemic levels. New York, 74%. Ouch. Chicago, 50%. Boston, 54%. And this has implications for retail, restaurants, and offices. So, like I said, right now, I work hybrid downtown Chicago. And I remember pre-pandemic, the whole loop area, it was pretty not intense, but you had a lot of people come downtown. Restaurants were packed during the weekdays. Now it's dead. A handful of the places are closed. Now there are some places that have remained open, but it sucks for those small businesses that have to deal with less people out there. Like, how many people are going to happy hour on Fridays? Not that many. So let's take a look at this. So about 1 billion in outstanding commercial mortgage-backed security loans in Houston secured by office properties are coming due this year. Dallas faces an aggregate over 1 billion in maturities by 2024. And refinancing risk over near term is high, and it's going to be really tough because interest rates are so high. There's going to be a lot of foreclosure. I think there's going to be bankruptcies. There's going to be a lot of distressed sales. Yeah, it really sucks. And that's why I think the Fed is going to be cutting this year. Not only that, I'm just wondering, okay, how does a bankruptcy work in this situation? Because I know that a plumber that I hired, he used to basically remove items from apartment buildings. Now that's apartment buildings that may be different. The contracts may be different in these buildings, but I remember the apartment complex went bankrupt. people paid rent, but then their stuff got taken. That's what he had to do. And then he felt bad doing that. So he switched his career to a plumber. So that was like 2008 that he told me. I mean, he told me that what, a year or 2 years ago, but he did that during the pandemic, not pandemic, but during 2008 crisis, 2009. And now this is from Wall Street Journal, but on MSN.com, commercial real estate runs deeper than in past downturns. Landlords are contending simultaneously with the cyclical market downturn and with secular changes in the way people work, live, and shop. The sudden surge in interest rates caused property values to fall, while the rise of remote work and e-commerce are reducing demand for office and retail space. Totally makes sense. And let's take a look at this. It's unknown how bad the commercial property downturn will get. Some analysts say it will end up less severe than the previous two downturns in the early 1990s and 2008 financial crisis, especially if the U.S. economy avoids a deep recession and interest rates start to come down quickly. Well, if they come down quickly, that's a short-term solution. That doesn't solve the fundamental issue that people are going to be working from home a couple days a week. That impacts the activity, especially in these big cities. You go in less, you don't have to pay that much. I mean, there's a Metro Pass right now. You don't have to pay an arm and a leg. Before I had to pay what, $220? Now I could pay half of that because I'm not going in. No one's going in that much. The Metro is the station, that take you to downtown Chicago. And it could take you around the suburbs too. All right. This in turn suggests that commercial real estate won't contribute as much to the country's economic growth as it had during previous rebounds. Depressed building values could hurt cities which depend on property tax revenue and weigh on bank balance sheets, leading to less lending throughout the country. Last thing I want to say is that, hey, look, or from this article, you literally have trillions of dollars of investment that are suddenly just massively impaired, said David Swern, chief executive of Arena Investors, a New York asset-based manager in real estate. Yeah, exactly. And it's all the result of easy money coming in, people throwing it in. And now, in the past, actually, they could have just roll over the debt. Now interest rates are high and there's not that much demand for these assets. So it's just really quite interesting what's going on, and it's unfortunate. But anyways, guys and gals, let me know what you think. Remember to smash that like button, subscribe if you haven't, comment down below. Thank you. Bye.